Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my partner, Chen Lin, publishes what his newsletter is called What is Chen Buying, What is Chen Selling? And in order to sign up for both those newsletters, you need to go to miningstocks.com. For Chen, you need to put your name on a waiting list, and then the first half a month of the new quarter, beginning July, he will accept new subscribers. You can also sign up for my newsletter. You don't have to put your name on a waiting list. Just go to miningstocks.com, and Jay Taylor's Gold, Energy, and Tech Stocks is always available there. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. I want to suggest that you continue to send your questions and comments to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. Also, follow me on Twitter @JTaylorMedia. I want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Carlisle Goldfields, Aran Resources, Cornerstone Capital Resources, and Callinex Mines. I've titled today's show, The Fed Will Never Raise Interest Rates, but the Markets Will. Dan Oliver and Michael Oliver return. Max Porterfield will be with me for the first time. Max will stop by at about 15 minutes from now. He will fill us in with what is going on with Callinex Mines. Well, this is a company that I have recommended in my newsletter. It's a company that has an operation in Manitoba that is doing very well. The shares have performed very well. It has a very promising base metals and precious metals project, a minuscule market cap of around $6 million, and I think it has enormous upside potential as the markets start to be a bit kinder to the precious metals and the base metals. Quantitative easing has led and is continuing to lead to the destruction of capitalism, in my view, and it's doing that by disabling price discovery for capital. I mean, how can you have capitalism if you don't allow capital to be priced properly? So not surprisingly, then, the Western economies continue their lackluster performance, and given the enormous amount of leverage added into the global economy by massive amounts of new debt money that have been created out of thin air, the Western economies are now sitting on the precipice of, I think, a cataclysmic credit market seize-up, akin to, or potentially, unfortunately, much worse than that we experienced in 2008, 2009, triggered by the Lehman Brothers default. It is impossible to know where the next so-called black swan will come from, but rest assured, with 100% certainty, it will come because as a result of the endless amount of money creation, black swans are now multiplying like jackrabbits. They're multiplying at exponential rates of speed, and so it's just a matter of time before we have our next credit bust, I'm afraid. It is idiotic, but most people have no clue that our monetary system, unlike a gold-backed system, is a debt-based system. They think money can just appear like manna out of heaven. But for every dollar that is created under this current system, there is another dollar of debt. And increasingly, every new infusion of this new debt money into the veins of the global economy results in less and less growth relative to the amount of debt that is being accumulated in the economy. And that's a result of what the Austrian economists understand very well as malinvestment. Money just isn't put to good use when you're not allowed capital to be priced properly. Therefore, I believe it is only a matter of time. There was an excellent article that was published at milesfranklin.com that I highly recommend you go to read. It was written by Bill Holter, and he talks about a problem that occurred. Actually, Zero Hedge mentioned this as well last week on Thursday. There was a near-market meltdown that started in the Eurozone when a very weak demand for a French sovereign bond when the markets were very weak and didn't really want to buy the thing, I guess, and so that sort of triggered a massive increase in the German Bund. And then the Euronext derivative markets were shut down, which gave central banks a chance to restore order by flooding the markets, pumping huge amounts of newly created money out of thin air into the system to try to keep things from imploding. This is just one more example as why the Fed and other central banks, in my view, will never raise rates. In fact, as this example shows, massive amounts of new money created out of nothing is required at a faster and faster pace just to keep the system afloat. The constant talk about Western central banks tightening credit to orchestrate rising rates is, in my view, a pipe dream and used only to con the public into believing that the Fed has the power to raise markets and to control markets. In fact, I believe the Fed and other central banks are impotent in that they cannot really raise rates, because if they do, the global system will, which is really teetering on the brink, in my view, will collapse probably immediately. And every time you hear the mere mention of raising rates, the equity market throws a hissy fit. So I think the central banks are aware that they're in this pinch, but what are they going to do other than try to make us think that they have control? Otherwise, the system comes apart sooner rather than later. Central banks clearly do not have control, in my view. And I think we're on to a tectonic shift potentially in the financial markets. Daniel Oliver will be joining me. That's Daniel Oliver will be joining me at about half past the hour today to discuss the credit markets and what that may mean for gold and silver. Daniel's recent article titled "Quoth the Fed Nevermore" is what prompted me to title today's show, "The Fed Will Never Raise Interest Rates, but the Market Will." Indeed, it does seem that the market is, in fact, raising rates over the objections of the Fed and other central banks. So the big question is whether or not the Fed is losing its credibility, and if so, what that will mean for the markets, including, of course, gold and silver. Well, my views and those of Dan Oliver and a lot of other people on this show are based on fundamentals, but I like to check my ideas against the collective wisdom of markets as revealed through technical analysis, and to help us see more clearly the language of the markets, the big ones anyway. I'm really pleased to have with me once again Michael Oliver. Thanks, Michael, for joining me again today.
Glad to be here.
Always good to have you. The treasury markets that I was just talking about, you're watching the 10-year Treasury very closely. What is your latest work suggesting? Are we seeing increased danger, or are we okay for a while? What are you seeing?
Increased danger. The T-note market, unlike the bonds and the JGB, all of these are 10-year markets. Those two dropped pretty sharply, the bond especially. Did a lot of damage about 2, 3, 4 weeks ago, and then they paid some dues since then. The T-notes only this week have sort of broken below levels that I considered to be floorboards that indicate more problems to come. So it could be a two-tiered problem here. In other words, we've seen a rout in the bonds lately and the JGB, and a modest pullback in the notes that have done some damage, but not comparable to the bonds. But I think as a trio, they've got problems now because the notes have done some serious damage this week, which it's a late comer, but it's adding to the negatives because it's now joined in. And in the longer term, I don't think any of these markets look fulfilled on the downside. I mean, the breakage that's occurred looks like initial response breakage, with more to come. But, with the bonds having gotten sort of somewhat oversold on a near-term basis, people could fantasize that, it's all over now. You get a bounce in the bonds or something. But I don't think so. I think the damage done is more long-lasting and is therefore more threatening to the equity markets.
Yeah, well, you were looking at a 127.25, I think, on a weekly basis. A close below that on the 10-year Treasury would cause you some concern. And I see today, in fact, right before we went on the show, it was at 126.31, I think, something like that. So it is actually below those levels. So you're really looking, though, on a weekly level, I guess. Forget today, or don't forget it, but at least let's see what happens by the end of the week, right?
Sometimes I make those decisions about, what do I want to see, a daily break below it, a weekly or a monthly, and that type of thing. And to some extent, it's subjective on my part, but the structures aren't. And we're breaking structures on dailies, weeklies, and so forth, and especially if you close the week below 127.25. Now, what we're talking about is the 10-year note futures contract, which is nearby the June contract right now, which, as you said, is below 127. And that just broke its intra-week below a floor, a momentum floor that goes back quite a ways. And so it's definitely a major break in the integrity of the uptrend of the lower yield trend in the T-notes. And that trend's been underway for a year and a half, so it's a break of a year-and-a-half trend. So I think there's more to come.
So I know, Michael, you're not going to want to say this probably, but could it be, I'm just asking the question rhetorically, could it be that we are approaching the end of a major bull market in treasuries that started back when I was still a young person? That was back in 1981.
Yeah, I think so. I think we were at that point, and it got to excesses, particularly in some markets like the bonds and the JGB where they, we approach zero rates or actually got some maturities below zero, which is off the page ridiculous. And, people like to rationalize it after the fact. Oh, well, that's okay. I mean, that makes sense. Well, 10 years ago, it wouldn't have made sense to anyone, including
for sure.
So it's rationalization. But so it did reach an extreme excess of zero rates or negative rates, and I think it's coming unwinding. And I think the point of it is what you made, is that there's a faith structure out there.
Yeah,
and it supports a lot of assets, equities in particular. And if they lose faith in the central banks, then all faith is gone.
Yeah,
and therefore panic can set in those asset categories where they're supported by that faith structure.
Right. After all, there's nothing real behind the dollar anymore. But let's talk about the equity markets briefly with the 2 or 3 minutes we have left here yet, Michael. You made a great call, I think, at the end of 2014. You talked about 2130 on the S&P being a momentum, sort of a momentum top, a resistance area. Then in March, you issued an updated report noting that 2130 area again, and then actually more precisely 2126. When I last checked the S&P earlier today, it was about 2100. How are you feeling about that call now? Still confident in it?
I still think that's the zone of a likely halt to the excess above last year's high. Remember, last year's traded high was 2093. We've traded below there today. Okay, it's 6 months since in December of last year, we saw that price closed last year at 2059. But the high last year was 2093, and we traded 2085 today. So it's really not going up. It's just hovering. And I think they're hope upon hope that somehow it'll launch itself again, and I don't see that. I think damage has been done. And pinning down that zone of 2130 and then specifically 2126, it looked like that's where it probably should peak. So far, the high has been 2125.9 something, I think. So just right below there, and we're 2100 area right now. So the question is, was that the high 2 weeks ago? I'm not sure. You get to 2070 on a daily close anytime this month, and I would circle it. I think you'd seen your high. And we got to 2085 today, and then they brought it back up to 2100. So 2070 is the level that I would circle this month. Now next month, that same breakage level will occur at 2090. So the bulls have a task here. It's a slippery slope. They've got to keep it going up, otherwise the default break down.
Okay, then it breaks down. All right, with a minute left or so yet, if we're seeing a topping process and some of the smart money coming out of the big equity markets, could the reverse be true in the gold markets? What are you seeing with gold and gold shares, Michael?
Two numbers I'll offer up. One, I think gold shares are a better place to be in any new emergent gold market. I think gold itself needs to give the signal, but I think the better vehicle is, for instance, the GDX or some ETF involving gold miners. Gold is in the mid-1190s. It's hovering. It's playing both sides, but not going anywhere, which is fine with me. The two numbers that I see as important are 1220. A weekly close there or higher. That's a very positive thing. 1255 to me that's it. You close a week, especially a month, at 1255 this quarter, and I think it launches. And at that point, I think I would defer though to the gold miners as the vehicle. Okay,
so the gold miners, gold shares may lead gold bullion up this time.
I think this time around the gold miners beat gold. Yes.
Okay, very good. Unfortunately, we are out of time. Always a pleasure talking to you. Thank you again, Michael, for sharing your insights. We'll watch these numbers very closely and hope to have you back next week. Thank you very much for being with us again.
Thank you, Jay.